When interest rates rise, many people immediately think about how it affects their savings accounts or their credit card debt. But one of the areas where rising rates have the biggest impact is refinancing. Whether it's homeowners looking to refinance their mortgage or borrowers considering refinancing other types of loans, the shift in rates can completely change the financial equation. Today, we're going to dive deep into how rising interest rates affect refinancing, what it means for homeowners and borrowers, and why timing can make all the difference when it comes to financial planning. Let's start with the basics. Refinancing is the process of replacing an existing loan with a new one, usually with the goal of getting a better interest rate, lowering monthly payments, shortening the loan term, or tapping into equity. When rates are low, refinancing often makes sense. You can reduce your monthly costs and potentially save thousands of dollars over the life of your loan. But when interest rates rise, the benefits of refinancing become harder to capture. The first and most obvious effect of higher interest rates on refinancing is that borrowing costs increase. A mortgage, for example, is essentially a long-term debt that depends heavily on interest rates. If you currently have a mortgage at 3% and the new market rates are at 6%, refinancing would actually raise your borrowing costs rather than lower them. That means your monthly payments would increase, not decrease, which defeats the whole purpose of refinancing for savings. Because of this, one of the clearest trends we see in the housing market is that refinancing demand drops sharply when interest rates go up. When rates are rising, homeowners with low-rate mortgages simply hold on to what they already have. They become what's often called rate-locked, meaning they're essentially locked into their current loans because refinancing at a higher rate doesn't make financial sense. This creates a ripple effect in the broader economy because fewer refinances mean less spending on things like home improvements, debt consolidation, or other big expenses people often cover through refinancing. Another key impact of rising rates is on monthly payments. If someone does decide to refinance in a high-rate environment, it's usually not because they want to lower their payments. Instead, it might be because they want to change the structure of their loan. For instance, someone with an adjustable-rate mortgage may choose to refinance into a fixed-rate mortgage even if the new interest rate is higher. They're essentially trading the possibility of lower payments in the short term for the security and predictability of knowing exactly what they'll pay each month in the long term. It's about peace of mind rather than savings. Rising rates also affect home equity loans and cash-out refinancing. These financial tools allow homeowners to tap into the equity they've built up in their homes, using it to cover expenses like debt consolidation, education costs, or major purchases. When rates are low, tapping into equity through refinancing can be a smart financial move. But as rates rise, the cost of accessing that equity also goes up. This makes cash-out refinancing less attractive because you end up paying more in interest for the money you're borrowing from your own home. At the same time, rising rates can influence the types of loan terms people choose when refinancing. For example, some borrowers might decide to refinance into a shorter-term loan, such as moving from a 30-year mortgage to a 15-year mortgage. While this might mean higher monthly payments, it also means paying off the debt faster and saving on total interest costs over the life of the loan. This strategy tends to appeal to borrowers with strong cash flow who want to become debt-free sooner, even if interest rates are higher. On the flip side, for borrowers who are already feeling the pinch of higher monthly costs, refinancing into a longer-term loan to lower payments may not even be an option if rates have risen too much. Credit qualification is another area that becomes more challenging as interest rates climb. Lenders often tighten their requirements in a high-rate environment. They want to make sure that borrowers can handle the increased financial burden. This means that a higher credit score, a lower debt-to-income ratio, and more equity in the home may be required to qualify for refinancing. Essentially, it gets harder for borrowers to meet the criteria, which reduces the pool of people who can even take advantage of refinancing opportunities in the first place. There's also a psychological factor that comes into play. When people know that rates are higher than what they already have, they become reluctant to make changes. This phenomenon, often called the lock-in effect, not only reduces refinancing activity, but can also slow down housing market movement overall. Homeowners may hold on to their current mortgages and homes longer, even if they might otherwise consider moving. This lack of mobility can reduce housing supply and affect buyers, sellers, and the broader economy. To summarize the key points, rising interest rates affect refinancing in multiple ways. They make borrowing more expensive, which reduces the number of homeowners who can benefit from a refinance. They discourage cash-out refinancing because accessing equity becomes more costly. They shift the reasons for refinancing away from saving money toward achieving stability or restructuring debt. They create stricter qualification requirements as lenders seek lower-risk borrowers. And they lead to a psychological lock-in effect, where people hold on to their current mortgages instead of refinancing or moving. But it's also important to point out that refinancing can still make sense in certain circumstances, even when rates are rising. For example, if you have an adjustable rate mortgage that's about to reset to a much higher rate, locking in a fixed rate now could save you from unpredictable increases in the future. Or if you're planning to pay off your loan in a shorter time frame, refinancing into a shorter-term loan could help you save on overall interest costs, even if the rate itself is higher. And for some homeowners, the need for cash through equity outweighs the additional cost of borrowing, making cash-out refinancing a necessary financial decision. In the bigger picture, rising interest rates are a reminder of how interconnected financial decisions are. A shift in central bank policies or market conditions doesn't just affect Wall Street. It directly affects Main Street, homeowners, and everyday borrowers. Refinancing is one of the clearest examples of this connection. When rates are low, it's an opportunity. When rates are high, it becomes a challenge. Understanding this dynamic can help you make smarter choices about when to refinance, why you're doing it, and what the long-term financial consequences might be. So if you're considering refinancing in today's environment, the key is to run the numbers carefully. Look at your current rate compared to what's available, calculate the potential savings or costs, and think about your long-term goals. Are you looking to save money on monthly payments, pay off your debt faster, or secure more predictable payments? The right decision will depend not just on the interest rate itself, but on your financial situation, your goals, and your tolerance for risk. At the end of the day, refinancing is a powerful financial tool, but like any tool, its effectiveness depends on when and how you use it. Rising interest rates may limit the opportunities, but they don't eliminate them entirely. By understanding the effects of higher rates on refinancing, you can approach the decision with clarity and confidence. And that's how rising interest rates affect refinancing.